Paul, there's a lot of anticipation about this news tomorrow. What are we expecting? What is the market thinking may happen?
Yeah, good morning, guys. So market's getting very excited about this briefing that we're having tomorrow by several of the Chinese regulatory authorities all at once, including the central bank, being held before market open. So a couple of things that tell you that it may be offering some kind of supportive measures for financial markets. Remember, the PBOC quite recently vowed that it was going to do more to fight against the risks of deflation. And we also heard that some of the briefings given by top government recently have been about trying to reduce financial risk. The problem is China, it looks like it's on course to miss its growth target of about 5% for the year. So need to do something about that to set the course back right. And what people are probably expecting here is a package of measures. It's not entirely clear exactly what that will look like, but some kind of reductions in interest rates seem likely, some kind of reductions in mortgage rates as well, which may help the housing market somewhat. But on the other hand, what we're not really expecting is some kind of big bang stimulus measure necessarily. That's not probably priced into the market. Market is willing to be disappointed, having been let down so many times before, because basically the Chinese authorities are happy to get to the 5% growth rate, but don't really want to push things a lot further and to inflate market risks too much more than that.
Well, Paul, if we do get this come through in the next 24, 48 hours, where does it show up and how quickly does it show up?
Yeah, so I think, interestingly, it may give some support to the equities market. It may also continue to weigh on bond yields. And remember, China also told us that it doesn't want bond yields to go too low or for there to be excessive risks, particularly at the back end of the yield curve. So there may be a resumption of that tug of war, that tussle between investors that want to buy those bonds and the authorities that want to keep the yields elevated. We're around the 2% level on the 10-year at the moment. We haven't fallen below that yet. So that's one area to watch, as well as the equities markets for some kind of support. Remember, Chinese stocks have had another drubbing in recent months, trading at 5-year lows on the mainland. So it doesn't take too much to lift sentiment there. Nonetheless, whether we will see something that really powers one of those bull markets remains to be seen.
Paul, we're waiting European PMIs. They're about to start dropping onto our screens within the next half hour. China is actually going to be a big feature of this landscape, both in terms of the French numbers and certainly with the German numbers. What are we expecting?
Yeah, so I think that the forecast for the PMI figures are predicting a little bit weaker manufacturing and quite significantly weaker services numbers relative to what we've seen recently. It's a slowdown on the services side. It's contractionary territory on the manufacturing side. So still that gloomy cloud hanging over the European economy. But for policymakers, there's still that dual thing to consider because inflation remains sticky as well. And so for the ECB, they still have to continue to sort of balance these risks about slowing growth along with the inflationary picture. We're expecting to see more cuts coming through in the rest of the year, of course, that may support markets, but it's not clear exactly how fast they'll be able to implement that.